What is dividend investing and how do we start to invest to create a passive income portfolio from dividends? Dividend investing is just a short expression of a concept that is much more complex. People who just buy random dividend stocks are not dividend investors. I think this is a very common misunderstanding. So let's see what is dividend investing exactly. What are the basics? First of all, dividend investors typically don't buy any stocks that pay dividends. Dividend investors are only buying stocks of a very specific group of companies. These companies are typically based in the United States, well-established companies, paying dividends, obviously, growing their dividends for at least 10 or 15 years or even decades, also called dividend growth stocks. Now we already reduced our possible targets to a few hundred companies. So if someone is just buying random dividend-paying stocks of companies, they are not dividend investors. Many people say that dividend is irrelevant, and I totally agree with them. Dividend itself alone is irrelevant. If you only look at the dividend yield, of course, it's completely irrelevant. But this doesn't mean that dividend investing is not working. It just means that the dividend alone is irrelevant because there are plenty of dividend-paying companies out there that a dividend investor would never buy. Because we only buy dividend growth companies. So the dividend payment history is the very first thing we need to look at. So for example, if we take a look at the dividend history of Pepsi, we can see this nice chart that shows that the company has been raising its dividend payments almost every year for a very long time. So just by looking at this chart, I already know that Pepsi is a dividend growth company, something that a dividend investor is typically looking for. And this is important because of two reasons. First, if a company is raising its dividends for decades, then we can expect them to do it in the future. And another thing is, the management of these companies know that investors have this expectation. So the company will do everything they can in order to keep raising the dividend. Because they know that otherwise investors would punish the company by selling out the stocks and pushing down the price of the stocks. So because of that, management in these companies makes smarter choices in how they allocate money in the company. Now let's take a look at the dividend history of another dividend-paying company. This is also a dividend-paying company, but as you can see, the dividend history tells us that the dividend payments are totally unpredictable. You can't expect anything from this stock. They paid dividends in the past, but they are not paying any dividends right now. So this is why I agree that the dividend alone is irrelevant, because there are many companies that pay dividends, but they are not dividend growth companies. And dividend investing is not about buying any stocks that pay dividends. If you just buy random dividend-paying stocks, you will not know what will be your dividend yield in the next year or in the next 15 years. You can only expect a growing dividend income if you are investing in dividend growth companies. And another thing that is important regarding the dividend payment history is that the longer they raise dividends, the better. Because of course, if a company is only raising dividends for 3 years, that's not a lot. That's probably not something a dividend investor is interested in. Ideally, a company should have a dividend payments history that went through at least one recession without any dividend cut. Now, does that mean that dividend growth companies never cut their dividends? No, it doesn't. Companies only pay dividends if they want to pay it and if they can pay it. If we are looking at a dividend growth company, we know for sure that they want to pay dividends, but a company can only raise its dividend if the revenue is growing. So another thing we need to check is the revenue growth. Now keep in mind that there can be fluctuations in revenue in any business on a quarterly basis, so this is why quarterly reports are not really relevant. Investors act on quarterly reports all the time and they sell the stock if they are not happy, but this is not very smart. I usually check the revenue for the past 10 years. If it shows a growing tendency, then it's fine. If you own a business, you know that the revenue can fluctuate in the short term because of many different things. Now keep in mind that I didn't even talk about the stock price yet. Didn't even talk about dividend yield yet, because these things are more important. Most investors make the mistake of looking at the stock price and they are trying to predict something from the short-term movement of the price. And other investors make the mistake of looking at the dividend yield. You can see that we are not starting with the dividend yield because the dividend yield alone is really irrelevant. First, take a look at the dividend payment history and then take a look at the revenue. These two things tell you more than anything else. The price chart doesn't tell you anything, and the dividend yield also doesn't tell you anything.